To begin, welcome to our deep dive on why credit unions can be your ultimate financial power move. Next, we will explore how credit unions differ from traditional banks, why size does not always equal better service, and how to evaluate a credit union with hard numbers rather than opinions. Finally, by the end, you will know exactly how to choose and join the right credit union for your needs. First, we will define what a credit union is. Then, we will cover why credit unions can provide better value than banks. After that, we will compare large and small credit unions and discuss the trade-offs. Next, we will walk through an exact method to compare rates and fees. Then, we will check eligibility through a field of membership checklist. Afterward, we will address online complaints and how to evaluate them. Finally, we will end with a practical action plan you can implement today. Before we proceed, this video is for educational purposes only and does not constitute financial, legal, or tax advice. Additionally, financial products, rates, and eligibility vary by institution and over time. Therefore, always verify details directly with the credit union, review official disclosures, and consult a qualified professional for advice tailored to your situation. To establish the foundation, a credit union is a member-owned, not-for-profit financial cooperative. Unlike a bank, which is owned by shareholders seeking profit, a credit union exists to benefit its members. Consequently, value is typically returned through better deposit yields, lower loan rates, and reduced fees. Moreover, many credit unions emphasize community impact and financial education. Next, let's cover why credit unions often win for consumers. Because they are member-first, their incentives align with returning value to you. In practice, that can mean lower average loan rates on products like auto loans, credit cards, and mortgages, as well as higher yields on savings and certificates. Additionally, many credit unions maintain fewer nuisance fees and aim for transparency. Finally, deposits are typically insured by the NCUA up to the applicable limits, offering comparable protection to FDIC coverage at banks. Moving forward, this flowchart explains a practical decision path. First, start with your goal: lower costs and raise savings. Then, verify your eligibility through the credit union's field of membership, such as employer ties, associations, or community residency. In parallel, compare each credit union's published rates and fees. Gather current loan APRs, savings APYs, and common fees. Next, benchmark those numbers against national averages. After that, compute potential savings for your situation. Finally, reach a decision point. If the institution meets your needs and meaningfully saves you money, move ahead to open your account and set up direct deposit. Otherwise, repeat the evaluation with another credit union. Meanwhile, consider the trade-offs between large and small credit unions. On the left, large credit unions often provide extensive ATM and shared branching access, advanced mobile apps, and a wide array of products, including home equity lines and business services. However, their visibility also attracts more online complaints, which might represent a very small fraction of their large membership. On the right, smaller or local credit unions can offer personalized service, community-oriented programs, and sometimes exceptional niche rates. Yet, they may operate with simpler technology and a more limited geographic footprint. Ultimately, the right choice depends on which features you actually use and what saves you the most money. Next, here is a purely illustrative table to demonstrate the comparison process. Compare your credit union's current rates to national averages for the same products. For example, check auto loans, credit cards, mortgages, savings accounts, and certificates. Then, mark which side is better for each category. Note that these numbers are examples only, and not current offers. Therefore, always verify the latest rates on the institution's website and consult an independent source for national averages. After that, follow a structured process. First, list the products you actually use. Second, pull your credit union's current APRs and APYs, and retrieve the full fee schedule from its website. Third, obtain national averages from a reliable source, such as NCUA, Bankrate, or industry reports. Fourth, compute the dollar impact for your actual balances and expected time horizon, examining both interest saved on loans and interest earned on deposits. Fifth, only after the numbers show clear value should you weigh technology, access, and service. Finally, Schedule a quarterly review because rates change and your loyalty should follow the money. Furthermore, ensure you meet the field of membership requirements before you get too invested. Check if eligibility is employer-based, association-based, community-based, or through a family or household relationship. In some cases, you can qualify by joining a partner nonprofit. Also, be prepared with identification and address verification, such as a driver's license and a utility bill. Confirm these details early to avoid delays when you decide to open the account. Additionally, this mind map visualizes the common eligibility routes. At the center is the field of membership. Branches include employer affiliation, such as a hospital system, school district, or technology company. Association membership, such as alumni groups or professional societies. Community-based qualifications via city, county, or place of worship. Family or household ties, including spouse and parent or child. And donation partners, where joining a nonprofit may grant eligibility. This layout helps you quickly identify the path that applies to you. Moreover, do not let isolated online outrage mislead you. Large credit unions serve millions of members, so raw complaint numbers can appear big without indicating a high complaint rate. For instance, 1,000 complaints out of 2 million members equals a rate of about 0.05%. Therefore, focus on complaint rate and on issues that actually impact your use case. Most importantly, prioritize verified data such as published rates, fee schedules, access options, and any documented service metrics. When reading reviews, look for consistent patterns relevant to your needs, such as mobile deposit limits or wire transfer fees. Now, let's test your understanding. The question is, which factor should carry the most weight when choosing a credit union? Option A, the number of social media complaints. Option B, the logo and branding. Option C, the rates, fees, and your eligibility. Option D, the number of branches in states you never visit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, the rates, fees, and your eligibility. The reason is that your goal is to minimize your interest costs and maximize your returns while ensuring you can actually join the institution. Other factors can matter, but they should be considered after the numbers prove clear value. Next, here is the second question. What should you do if a large credit union has many online complaints but offers significantly better rates for your needs? Option A, avoid it automatically because complaints are scary. Option B, join without reading any details. Option C, calculate savings, check the complaint rate, and confirm the issues do not apply to you. Option D, pick a smaller credit union even if it costs you more. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, calculate your potential savings, evaluate the complaint rate rather than raw numbers, and verify whether the issues cited would actually affect your usage. This balanced approach allows you to capture real financial value while managing potential risks. To recap the essentials, credit unions are member-owned and often return value to members through better rates and fewer fees. Always compare the products you use against national averages and quantify the impact in dollars. Confirm eligibility early through the field of membership. Understand the size trade-off between technology and convenience on one side and personalization and community on the other. Do not let isolated complaints dictate your decision. Instead, focus on complaint rates and issues relevant to you. Finally, review your choice quarterly and let your loyalty follow the money. As we conclude, here is a concise action plan. First, list your actual products and balances. Second, retrieve the credit union's APRs, APYs, and fee schedule. Third, obtain national averages from reliable sources. Fourth, compute the dollar impact for your situation. Fifth, confirm your eligibility through the field of memberships. Sixth, evaluate technology, access, and service fit once the numbers justify it. Seventh, make your decision and set a calendar reminder to review quarterly. In summary, credit unions' member-first model can translate into lower borrowing costs and higher savings yields. Choose based on quantifiable results rather than online gossip. Confirm eligibility first, compare comprehensively, and compute your potential gains. Finally, reassess regularly because rates change, and your optimal choice may change with them. Thanks for watching. Before you go, if you found this useful, please like the video, share it with someone who wants to save more, and subscribe for more practical money content. In the comments, tell us which credit union you are considering and what rates you are seeing right now. Your insights can help the entire community.